Okay, one concept is reversal of impairment. So reversal of impairment, IAS 36, we already know what is impairment. No need to go back and talk a lot on that. We know that impairment is what is happening in impairment, that when you have your carrying amount, which is called net book value, it is greater than your recoverable amount, which is like what you can recover from the asset. You say that impairment has happened. This is concept of impairment. You can consider impairment as your, the depreciation additional or advance which you are charging. Let's suppose that you have some asset. I call it that you purchase an asset on 01/01/2010. Let me put the date, not here. Let me put the date here. So on 1st January 2010, you purchase an asset for, I don't know, let's call it 1 million, and keep very simple numbers. Life of the asset is 10 years. I'll just put very simple numbers so that we don't get confused. We can handle them without calculators. And therefore, your depreciation per year is, this 1 million divided by 10. So 100,000 is your depreciation per year. Then what happened that on 01/01/2013 or 2014, 3 years have passed, 10, 11, 12, 13, 10, 11, 12. Okay, let's call it 13. So 3 years passed. Let me call it here. 3 years passed. If 3 years have passed, it means that on 1st January 2013, or let me just keep it very simple so that we don't make confusions. Let's call it 31/12/2012. 10, 11, 12, 3 years are gone. Asset, net book value, which you also called carrying amount. 3 years depreciation has gone, so it would be 700,000. And then you say that on this particular date, you say that fair value of asset in the market is 600,000. So this is actually your recoverable amount. The recoverable amount of the asset is just 600,000. And we know that an asset cannot be shown in statement of financial position higher than the recoverable amount. This is the maximum which you can show. So clearly there is an impairment loss which has happened. Impairment loss has happened, and that impairment loss is $100,000. So this impairment loss you take to the income statement, you would say debit impairment loss, credit non-current asset with 100,000. This is the double entry which you will make 100K here and 100K there. And you would say that on 31/12/2012, new carrying amount of asset will be now 600,000. You just reduce the value of the asset. And from now on, the life remaining, I would say that remaining life of asset, you need to calculate how much is the remaining life of asset. So before we said that 3 years passed, okay? We took this assumption that 3 years passed. So 7 years are remaining. So you would say that new depreciation. From now on, your depreciation will be 600,000 divided by 7. It should be 85,714. A bit strange number, but we cannot do anything. I will take this number. I cannot change the number. I cannot change the number. I will keep it like this, okay? I mean, no more rounding. And then what happens? That 13, 14, and 15. 13, 14, and 15, 31st December 2015, I would say that 3 years passed. Further 3 years passed. Now you should remember that whenever you do impairment or you do revaluation, you always have to calculate the new depreciation because the value of asset changes. Therefore, the depreciation should also change. And then you started charging this 85. So first what you were doing, you said 1 million and you said minus 100,000 and you made a total. You were doing it at straight line. Then in year 1, in year 2, you again subtracted 100,000 and you got the value of asset as 800. In year 3, you again subtracted 100,000 and you got the value of asset as 700K, okay, in your books. But then you did impairment, and here you just did impairment. This is my impairment, and the value of asset, it becomes 600K. So I'm just putting it here, the numbers, so that you don't get confused. Now I've got 600. So in 4th year, the depreciation will be this 85,714. This is your depreciation which you will charge in year 4. And then you come like this here. And then again, this depreciation. This times -1, and you calculate this much. So this is your depreciation for year 5. Let me put these numbers in order. So you've got 428. And here comes year 6. And in year 6, again, you took the same depreciation, okay? And you get here. So your book value, your balance sheet value, your carrying amount at the end of 3 years is now 342,000. So 3 years more passed. So 3 years passed there, 3 years passed now, 6 years have gone. And first 3 years I was charging 100, 100 and 100. And next year I was charging 85, 85 and 85. And in my books, the asset is only 342,856. And the useful life, and I would say here that my asset book value, I'm just creating a long scenario. I'm sorry for taking too much time, but I just want to explain it in detail. This is your asset net book value at the end of 6 years, okay? I would call it at the end of 6 years. I just want to make sure that you don't forget it. Once you understand, you don't forget it. 6 years. You've got here 342,857. Now what happens? You say that fair value of asset is now 450,000. Now asset has gone up. If asset has gone up, now it is a scenario which you call reversal of impairment. Your book value of the asset is 342 and the fair value of the asset in the market is 450. So how much is increasing? Or let me even call it not 450, that's a pretty big number. Let me put it as 420,000. I'll just put 420,000. So the asset is increasing in value by 77,000. 77,000, asset has gone up. So what happened? That before asset went down as impairment, now it is going up, which is called reversal of impairment. Now, this is not a normal case of revaluation. You do revaluation of those assets which you have not been impaired before. This is an asset which you already had impaired before. And now when the value is going up, you can consider that it is kind of, impairment reversal. Now, can we increase the value of this asset with 77,143, yes or no? The answer is that here IFRS says you that IAS 36, it says you that increase should not make the asset value more than what it could have been without impairment. I mean, I can increase the value, but this increase should not make the asset value more than what it could have been without impairment. This is my words. I mean, the standard uses different words, but I'm just trying to explain like this. What does that mean? It means that the total 6 years, I got the asset for 1 million. And 6 years have passed. We said that total 6 years have passed. Originally, we assumed that there was $100,000 depreciation. Okay, so let's suppose there was no impairment. If that impairment had not happened, in 6 years, you would have charged 600,000 as depreciation. Ignore impairment for a moment. If there had been no impairment, you would have charged 600,000 as depreciation, right? So your asset would have been 400,000. I mean, in the absence of any impairment, your asset would have been 400,000. So when you do reversal of impairment, you cannot take the value of asset more than that. You see, here it says market value of the asset is 420. You cannot make it 420 because the maximum you can go is only 400,000. That's all. Even if you imagine that there had been no impairment, what you can reverse? You can only do reverse what you have taken the impairment. So if I take this number, it means that I'm just ignoring impairment. So if I take it back to 400,000, if I say that if I, increase the asset to this 400,000. If I increase the asset to 400,000, it means I just reversed all of the impairment. It means that I just ignored all of the impairment. This is called impairment reversal. So you cannot take 77. Actually, what you can take is 400,000 minus 342. This is what you can take, 57,143. And this goes to debit non-current asset and credit your P&L. Credit your P&L. This is the amount, 57,143. You cannot take 77 because if you take 77, it will take asset higher than its carrying value. You should consider that if I had not done the impairment, how much this asset would have been as per my original depreciation without impairment. I can only take it until that point, which is 400,000. So this is your reversal of impairment. And why do we do that? We do that because let's suppose that, just go back to your previous knowledge. You have cost model. You put the asset in cost model. So if you ignore the impairment, your cost model would have said that asset is 400,000. Maybe in market is 420,000, this much. What do? Do you take it up? You do not take it up. You keep it at cost model 400,000. So I'm just taking it back to my original price, which is 400,000. No need to go to 420. I just go back to my cost model of 400 and I assume that no impairment had ever happened. And when you reverse 57,143, it means that you actually have, reversed all of the impairment. If you actually, you should be doing 57,143 so that you are bringing it to 400,000. This is what it should have been without impairment. If you start charging 75, Let's suppose that you say, no, I'm going to, reverse 77 because it was 342 on the books. In market, it is 420. I'm going to put 77,413. So if you are taking 77,413, it will take asset to 420, which it should have been only 400. You are taking it 420. It looks like that you are doing revaluation. Okay. You are increasing. It looks like that in the books, it should have been 4. Market, it is 420. And you are taking it to 420. So essentially, it looks like you are doing revaluation. We are not doing revaluation. We are going for cost model. We have a cost model here. Okay. We go back only to the original value. Because inside of 77 and 57, the 20,000 difference is kind of revaluation, like when the market value of the asset goes up. In reversal of impairment, my objective is not to increase the value of asset. My objective is just to take the asset back to the original position, just to take away the impairment which I have written. Whatever impairment I have made, which is 57, I just reverse that word. I don't have any intention of adding it further 20,000 and doing the revaluation of 20,000. That 20,000 I will do if I use the revaluation model. Then I will take 20,000 into revaluation and not into impairment.